Selling low-delta put credit spreads is a popular strategy among options traders for several reasons. Low delta. A low delta option means that it is less sensitive to changes in the underlying asset's price. This makes it less likely to be affected by small fluctuations in the market. Time decay. Options lose value over time, regardless of the underlying asset's price. This time decay works in favor of the seller of a put credit spread, increasing the probability of profit as the expiration date approaches. Defined risk. The maximum loss on a put credit spread is fixed and known at the time of the trade, making it easier to manage risk. Capital efficiency. Low delta put credit spreads require less capital compared to other strategies like buying options. This makes them suitable for traders with smaller account sizes. Income generation. Selling put credit spreads can generate income in the form of the premium received up front. This can be a valuable way to supplement income or grow a smaller account. Strike price selection. Select strike prices that are sufficiently out of the money to ensure a low delta. Expiration date. Consider the time frame that aligns with your investment horizon and risk tolerance. Risk management. Always monitor your positions and be prepared to adjust or exit the trade if necessary. While selling low delta put credit spreads can be a profitable strategy, it's essential to understand the risks involved and to have a solid understanding of options trading before implementing this strategy. It's recommended to consult with a financial advisor or conduct thorough research before making any investment decisions. Low delta. A low delta option means that it is less sensitive to changes in the underlying asset's price. This makes it less likely to be affected by small fluctuations in the market.